$5,300 gold and 115 silver, the inflation wave, just hit S&P 7,000. When the stock market celebrates and gold explodes simultaneously, history whispers a warning most will ignore. January 2026, the S&P pierces 7,000. Gold shatters every record at $5,300. Silver surges past $115. Wall Street cheers. The White House celebrates. Retirement accounts show gains never seen before. But something is fundamentally wrong, because in the entire history of modern finance, when everything rises together, it has never meant what people think it means. The denominator is collapsing. Welcome to Economy Revelations. If you've been watching financial markets for decades, you know that certain patterns simply don't occur naturally. You've seen bull markets, you've seen gold rushes, but you've rarely seen both at the same time. This channel exists for those who remember when analysis meant something more than headlines. If you appreciate thoughtful examination of economic events, the kind of perspective that looks beyond tomorrow's ticker, then you're in the right place. Consider subscribing, not with a hurried click, but with the understanding that what unfolds in the coming months will require the kind of steady, informed perspective that isn't found in 30-second news clips. And wherever you're watching from, New York, London, Mumbai, or Sydney, the events described here will reach your doorstep. The question is only whether you'll recognize them when they arrive. Now, let's examine what actually happened in January 2026 and why it matters far more than the celebrations suggest. On January 28, 2026, financial markets recorded an event that seasoned analysts recognized immediately as historically abnormal. The S&P 500 index breached 7,000 points for the first time. Simultaneously, gold reached $5,300 per ounce, and silver surged past $115. On the surface, these appeared to be independent celebrations of economic strength. In reality, they represented something far more concerning. Traditional market theory operates on a fundamental principle of balance. When investors feel confident about economic growth, they allocate capital toward risk assets, stocks, corporate bonds, and growth-oriented investments. When uncertainty rises, capital flows toward safety, gold, silver, and government securities. The seesaw mechanism has governed market behavior for generations. What occurred in late January 2026 violated this principle entirely. Both sides of the seesaw rose simultaneously. Risk assets and safe haven assets surged together, creating a pattern that financial textbooks describe as theoretically impossible under normal conditions. The explanation requires understanding a concept most business owners have never encountered: the crackup boom. This term, introduced by Austrian economist Ludwig von Mises nearly a century ago, describes a specific phase in currency collapse. It occurs when the public begins to lose confidence in money itself. In a crackup boom, people don't buy assets because they expect those assets to become more productive or valuable in real terms. They buy assets, any assets, because they expect the currency to become less valuable. The rush isn't toward what's good, it's away from what's dying. President Trump's response reflected the surface-level interpretation most people adopted. His social media announcement declared, "America is back," and celebrated the greatest economy ever, based on stock market performance. Major financial news networks echoed this optimism. Retirement account statements showed gains that made holders feel wealthy. But wealth is measured in purchasing power, not numbers on a screen. And purchasing power is determined by what those numbers can actually buy. The business community faced a critical interpretation challenge. Should they trust the nominal gains? Should they expand operations based on apparent market strength? Or should they recognize the rally for what it actually represented? A warning signal of monetary system stress? History provides clear guidance. Every instance of simultaneous rises in stocks and precious metals has preceded periods of severe currency instability. Weimar Germany in 1923 saw stock prices reach astronomical heights just before the currency completely collapsed. The German stock market index rose vertically, while bread required wheelbarrows of cash to purchase. Zimbabwe's stock market in 2008 became the world's best performer in nominal terms, rising thousands of percentage points. Shareholders became trillionaires on paper. Yet this wealth couldn't buy a week's groceries. The currency had entered terminal decline, and asset prices reflected desperation rather than prosperity. Venezuela's Caracas Stock Exchange similarly posted extraordinary gains between 2016 and 2018, even as the nation descended into economic catastrophe. Stocks rose because bolivars were dying. The pattern is consistent and unmistakable. When everything priced in a currency rises together, the currency itself is the variable in crisis. By late January 2026, the United States dollar faced precisely this dynamic. Decades of debt accumulation had created a mathematical trap. The federal government owed more than $36 trillion. Annual interest payments alone exceeded $1.2 trillion, more than the defense budget. The Federal Reserve faced an impossible choice: raise interest rates and trigger government insolvency, or continue printing money and destroy the currency's value. They chose the printing press, and markets began pricing in the consequences. For the business owner watching their portfolio surge, the instinct was celebration. But experienced analysts recognized something different. They saw the early stages of a currency crisis. They understood that when the denominator in every price equation begins failing, all nominally priced assets rise together. The rally wasn't a sign of strength. It was a symptom of collapse. And what happened next would prove that interpretation correct in ways that would reshape the American economy for a generation. The inflation wave had indeed hit, but the tsunami was still building offshore, and most people were still on the beach, celebrating the unusual warmth of the receding water. They didn't yet understand what comes next when the ocean pulls back this far. A businessman opens his brokerage statement in early February 2026. His portfolio shows a 23% gain in 30 days. He feels wealthy. He considers purchasing a larger office space. He contemplates hiring additional staff. The numbers on the screen tell him his net worth has exploded. But there is a question he has not yet asked. Wealthy in what? This is the denominator crisis. And understanding it separates those who survive currency collapse from those who are destroyed by it. Every price in an economy is a fraction. The numerator represents the asset, a stock, a property, an ounce of gold. The denominator represents the currency used to measure it. For decades, Americans have watched the numerator move while assuming the denominator remained stable. A stock rose from $50 to $100, and people believed the company had doubled in value. But what if the dollar had been cut in half? January 2026 marked the moment when the denominator began visibly deteriorating. The S&P reaching 7,000, while gold simultaneously hit 5,300, revealed a mathematical reality most investors had not confronted. Both numbers could be rising, not because assets were gaining value, but because the measuring stick itself was shrinking. Consider a simple thought experiment. A farmer has 10 chickens. He sells them for $10 each, earning $100. The next year, he sells 10 chickens for $1,000 each, earning $10,000. Has he become wealthy? Not if bread now costs $500 per loaf. His chicken inventory remained constant. The currency collapsed. This is precisely what began unfolding across American markets in early 2026. Corporate earnings reports showed revenue increases of 30%, 40%, even 50%. CEOs celebrated record performance. Stock prices surged in response, but a closer examination revealed something disturbing. Physical unit sales had barely changed. Companies were selling the same number of products. They were simply charging multiples more in dollar terms. The Federal Reserve had engineered this outcome through policy decisions made over the preceding decade. When COVID-19 struck in 2020, the central bank had expanded the money supply by approximately 40% in a single year. Then came the infrastructure spending bills, the energy transition subsidies, the stimulus programs, the banking crisis interventions of 2023. Each event added trillions to the monetary base. By 2026, the M2 money supply, the broadest commonly cited measure of dollars in circulation, had more than doubled from its 2019 level. The Federal Reserve's balance sheet exceeded $9 trillion. Government debt had surpassed $36 trillion, with annual deficits running above $2 trillion, despite official economic growth. The mathematics were straightforward. More dollars chasing relatively similar amounts of goods and services meant each dollar purchased less. But this process doesn't unfold uniformly. It moves in waves and stages and accelerating bursts. The first stage, which lasted from 2020 to 2024, saw the new money concentrated in financial assets. Stock markets rose. Real estate values climbed. But consumer prices remained relatively controlled. The inflation appeared manageable, perhaps 3% to 4% annually by official measures, 8% to 12% by more honest accounting. The second stage began in late 2024. Consumer prices started accelerating noticeably. Groceries that cost $100 in 2020 now required $180. Gasoline that had been $3 per gallon reached $6, then $8. Insurance premiums doubled. Rent increases outpaced income growth for 70% of Americans. The inflation could no longer be hidden in financial asset appreciation. It had reached Main Street. The third stage, the one that January 2026 signaled, was the loss of currency confidence itself. This is when velocity increases. This is when people begin spending money faster because they expect it to be worth less tomorrow. This is when the psychology shifts from save for the future to buy anything real today. History demonstrates this progression with brutal clarity. Weimar Germany followed this exact pattern from 1920 to 1923. The first year saw manageable inflation. The second year brought noticeable price increases. The third year began the acceleration. By the fourth year, prices were doubling every few days, then every few hours. Zimbabwe's currency collapsed over 7 years, from 2001 to 2008, following the identical progression. Early years showed modest inflation. Middle years brought significant but manageable price increases. Final years saw complete collapse, with prices eventually doubling every 24 hours. Venezuela's Bolivar died over a similar timeline, from 2013 to 2019. Each stage lasted approximately 2 years. Each stage accelerated beyond what experts predicted. The United States in 2026 stood at the transition between Stage 2 and Stage 3. The simultaneous rally in stocks and precious metals marked this inflection point precisely. Investors were no longer buying assets based on productive value. They were buying anything that might preserve purchasing power as the currency failed. The Federal Reserve faced an impossible mathematical constraint. Raising interest rates to 8%, 10%, or 12%, the levels historically required to break serious inflation, would make the government's debt service costs exceed $3 trillion annually. This would represent nearly half of all federal tax revenue going purely to interest payments. It would trigger either massive program cuts or explicit default. Maintaining low interest rates meant continued monetary expansion. Each Treasury auction required the Federal Reserve to purchase larger portions of newly issued debt. Each purchase meant more dollars created from nothing. Each new dollar diluted every existing dollar. The denominator was dying, and no policy option could save it without accepting economic pain that no politician would voluntarily choose. So the printing continued. And January 2026's impossible rally was simply the market's first clear recognition of what that meant. The question facing every business owner, every investor, every person holding dollar-denominated assets was no longer whether the currency would lose value. It was how fast, and whether they would recognize the acceleration in time to respond. Most would not, because the human mind struggles to comprehend exponential change. People think linearly, they project tomorrow based on yesterday. They assume the pattern that held for decades will hold for decades more. But mathematics doesn't care about assumptions, and the denominator was already collapsing faster than the headlines suggested. What came next would prove that beyond any doubt. There is a moment in every currency crisis when theory becomes reality, when the academic discussions end and the grocery store line begins, when the spreadsheet projections transform into the business owner standing at his supplier's warehouse, checkbook in hand, being told that yesterday's price quote is no longer valid. That moment arrived in March 2026. A textile manufacturer in North Carolina received an email from his cotton supplier at 6:47 a.m. on a Tuesday morning. The message was brief. Effective immediately, all previous quotes are void. New pricing requires prepayment. We cannot hold inventory on net 30 terms anymore. This was not an isolated incident. It was the canary in the coal mine. Across the American economy, a fundamental shift was occurring in business behavior. For decades, commerce had operated on trust extended through time. Suppliers offered net 30 or net 60 payment terms. Contractors provided quotes valid for 90 days. Lease agreements locked in rates for years. The entire architecture of business planning assumed the dollar would hold relatively stable value over these timeframes. That assumption died in spring 2026. The acceleration began in commodity markets. Oil suppliers, who had traditionally offered monthly contract pricing, switched to weekly updates, then daily revisions. By late March, some were adjusting prices twice per day. Agricultural wholesalers stopped offering forward contracts entirely. The risk of being locked into a dollar-denominated price while the dollar deteriorated had become unacceptable. Construction companies faced immediate crisis. A commercial builder in Texas had signed contracts in January 2026 to complete 3 projects at fixed prices totaling $18 million. By April, his material costs had increased 40%. Steel prices had surged. Lumber had spiked. Concrete suppliers demanded immediate payment rather than the traditional net 45 terms. The builder would lose $2.3 million completing work. He was contractually obligated to finish. He was not alone. Contractors nationwide found themselves trapped in agreements made when the dollar was worth more than it had become. Many simply walked away from projects, accepting legal consequences rather than financial annihilation. Construction sites across the country sat half-finished, abandoned mid-project. Retail stores encountered a different version of the same problem. Inventory that sat on shelves for weeks now represented a loss. A hardware store owner in Ohio purchased 500 gallons of paint in February for $28 per gallon. By the time he sold the last gallon in April, his supplier was charging $47 for the same paint. He had sold his entire inventory and lost money doing it. The rational response was obvious. Raise prices faster. Stop holding inventory. Order only what could be sold immediately. This behavior, multiplied across millions of businesses, accelerated the very inflation driving the decisions. Economists call this inflation velocity, the speed at which price increases propagate through the economy. In a stable currency environment, velocity is low. A manufacturer raises prices, but waits months to see if the market accepts them. Retailers absorb some increases temporarily. The process moves slowly. In a currency crisis, velocity approaches instantaneous. Everyone raises prices immediately because everyone expects costs to be higher tomorrow. The hesitation disappears, the absorption buffer vanishes. Price increases move from supplier to manufacturer to distributor to retailer to consumer in days rather than months. By May 2026, the average American grocery bill had increased 60% from January levels, not annually, in 4 months. Gasoline that had been $8 per gallon in February reached $14 by late May. Electricity bills doubled. Insurance premiums jumped 80% at renewal. Wages could not keep pace. The median American worker received perhaps a 12% raise during this period, if they received any adjustment at all. The gap between income growth and living cost increases widened into a chasm. This created a second-order effect that business owners had not anticipated: demand destruction. As consumers' purchasing power collapsed, they stopped buying anything non-essential. Restaurants saw traffic decline 40%. Retail clothing sales plummeted. Auto dealerships reported their worst months in decades. The economy was simultaneously experiencing inflation and recession, a phenomenon economists had labeled stagflation in the 1970s, but which now appeared in far more severe form. Then came the international response. Foreign holders of U.S. Treasury debt, particularly China, Japan, and Saudi Arabia, recognized what American politicians refused to acknowledge. The dollar was being deliberately devalued to manage unpayable debt. These nations held trillions in dollar-denominated bonds that were losing purchasing power by the week. Their response was coordinated and devastating. In a series of announcements beginning in late May 2026, major foreign governments declared their intention to reduce dollar reserve holdings. China announced it would no longer purchase new U.S. Treasury debt. Japan indicated it would allow existing holdings to mature without replacement. Saudi Arabia stated that future oil contracts would be priced in a basket of currencies rather than dollars exclusively. The bond market, which had been teetering on the edge of crisis for months, finally broke. Treasury yields, the interest rate the U.S. government must pay to borrow money, spiked from 4.5% to 7.2% in a single week. This meant the government's borrowing costs had just increased by 60%. The Federal Reserve faced its nightmare scenario. Allow yields to rise and the government becomes insolvent under interest costs alone. Suppress yields by purchasing bonds, and the money printing accelerates to levels that guarantee hyperinflation. They chose the latter, because the alternative was immediate government shutdown. On June 3, 2026, the Federal Reserve announced an emergency liquidity program that was, in plain language, direct monetization of government debt on an unprecedented scale. They would purchase $400 billion in Treasury bonds per month, nearly $5 trillion annually, to maintain orderly market functioning. The currency markets responded within hours. The dollar index, which measures the dollar's value against other major currencies, dropped 8% in a single trading session. Gold reached $6,100 per ounce. Silver breached $140. But more telling than the precious metal surge was what happened to basic commodities. Wheat futures jumped 22% overnight. Corn rose 18%. Soybeans increased 25%. The world was watching the United States destroy its currency in real time, and commodity producers were responding rationally. They wanted more dollars today because tomorrow's dollars would be worth less. Inside America, the real economy began fracturing in ways that financial markets couldn't capture. Trucking companies stopped accepting loads with payment terms beyond 48 hours. Wholesalers demanded cash on delivery. Some businesses began requesting payment in gold or foreign currencies rather than dollars. A furniture manufacturer in Michigan received an order from a retail chain for $800,000 worth of goods. The contract specified payment in 60 days. The manufacturer declined. "I can't price in dollars that far forward," he explained to the bewildered buyer. "Pay me today, or pay me in something that holds value." This was the chain reaction in motion. Each rational individual decision to raise prices immediately, to refuse payment terms, to demand hard assets rather than currency, combined to accelerate the crisis exponentially. By summer 2026, the United States had entered a phase that economic textbooks describe, but modern Americans had never experienced: a full currency confidence crisis. The stock market still showed the S&P above 7,500. Asset prices in nominal terms continued rising. But the gap between paper wealth and practical purchasing power had become a canyon. A business owner who had celebrated his portfolio gains in January now stood in that canyon, watching his suppliers refuse his dollars and his customers unable to afford his products. The denominator hadn't just cracked, it had shattered, and the pieces were still falling. By August 2026, the American business landscape had separated into two distinct categories: those who understood what was happening and those who were being destroyed by it. The difference was not intelligence, it was not luck, it was recognition. A commercial real estate investor in Denver provides the clearest example of this divide. In February, when the stock market was celebrating its climb past 7,000 and financial media was declaring economic triumph, he made a decision that his peers called insane. He sold 4 properties, premium office buildings in desirable locations, for $32 million in total. His colleagues questioned his sanity. The real estate market was surging. Property values were climbing 3% monthly. Why sell appreciating assets? His answer was simple. I'm not selling real estate, I'm selling dollars. He took the $32 million and immediately converted it into a combination of physical gold, productive farmland, industrial equipment, and foreign currency-denominated bonds. By August, those 4 office buildings he had sold were nominally worth $48 million, a 50% increase in 6 months. But the dollar had lost 65% of its purchasing power against tangible goods. The building's new owner was trapped. His rental income, denominated in rapidly devaluing dollars, couldn't cover maintenance costs that were rising daily. His tenants were defaulting because their businesses couldn't survive the inflation. His properties were worth more in dollar terms and simultaneously worthless in practical terms. The Denver investor, meanwhile, had preserved actual wealth. His gold had risen from $5,300 to $7,800 per ounce. His farmland was generating income in the form of crops, real goods with inherent value. His industrial equipment could be leased for payment in commodities rather than currency. This was the fundamental strategic principle that separated survival from destruction. Nominal value had become meaningless. Only real value mattered. Business owners who continued operating under pre-crisis assumptions found themselves in an impossible position. A restaurant chain operator in Florida had built his success on a specific model: operate on thin margins, achieve profitability through volume, maintain consistent pricing to build customer loyalty. By summer 2026, this model had become a death sentence. His food costs were increasing 5% to 8% weekly. His labor costs were climbing as workers demanded wages that kept pace with grocery inflation. But raising menu prices drove away customers who could no longer afford restaurant meals. He faced 3 options: close permanently, continue operating at a loss until bankruptcy, or fundamentally restructure his entire business model. He chose restructuring. Within 6 weeks, he had transformed his operation completely. Gone was the extensive menu offering 47 items. It was replaced with 6 core dishes made from ingredients he could source locally on short notice. Gone were the printed menus with fixed prices. They were replaced with digital boards updated daily based on ingredient costs. Gone was the spacious dining room seating 120. Half the space was converted to a market selling shelf-stable goods at current prices. The business that emerged looked nothing like the restaurant he had operated for 15 years, but it survived, because he had recognized a truth that many of his competitors refused to accept. The old model was designed for a different economic reality, and that reality no longer existed. Manufacturing operations faced an even more complex challenge. A machine shop in Pennsylvania had built its reputation on precision work for aerospace contracts. These contracts typically spanned multiple years with pricing locked in at the beginning. In a stable currency environment, this provided predictable revenue and allowed for careful business planning. In a currency crisis, it guaranteed bankruptcy. The shop owner recognized this in April 2026. He held $8 million in outstanding contracts at fixed prices. His material costs were already 40% higher than when he bid the work. Completing the contracts would destroy his company. He made a decision that seemed impossible. He returned $6 million in deposits, broke the contracts, and accepted the legal and reputational consequences. Then he restructured completely. New work would only be accepted on a cost-plus basis with weekly price adjustments. Payment would be required in advance or in the form of materials supplied by the customer. Long-term contracts were dead. His reputation took an immediate hit. Several longtime customers severed relationships. Industry forums criticized his lack of integrity. But 6 months later, those critics were filing bankruptcy while his restructured operation remained solvent. This pattern repeated across every sector of the economy. The businesses that survived were those willing to abandon models built for currency stability and embrace models designed for currency chaos. Several principles emerged as universal. Inventory became a liability rather than an asset. Holding goods purchased at last month's prices meant selling at a loss when costs had risen. The successful businesses moved just-in-time purchasing, ordering only what could be sold immediately, even if this meant higher per-unit costs and frequent stockouts. Long-term contracts in dollar terms became unacceptable. Every agreement needed either explicit inflation adjustments, payment in tangible goods, or prices denominated in inflation-resistant benchmarks like gold weight or commodity baskets. Cash flow transformed from a goal to an obsession. Money received today was worth more than money received next week. Payment terms collapsed from net 60 to cash on delivery or payment in advance. Businesses offering credit to customers were essentially making high-risk loans in a depreciating currency. Debt became a strategic weapon, but only specific kinds of debt. Fixed-rate, dollar-denominated debt locked in before the crisis allowed borrowers to repay in devalued currency. A business owner who owed $2 million at 5% interest from 2024 would repay that loan in 2027 with dollars worth a fraction of their original value. However, new debt or variable rate debt was catastrophic, as interest rates were climbing to double digits and accelerating. Foreign currency operations became essential. Businesses that could invoice in Swiss francs, Singapore dollars, or Norwegian kroner gained immediate advantage. They could preserve value across the transaction timeline. Domestic-only operations struggled to maintain any pricing stability. Physical assets replaced financial assets in smart portfolios. A construction company owner liquidated his stock portfolio in May 2026, selling near the nominal peak, and used the proceeds to purchase excavators, bulldozers, and trucks. The equipment could be leased for payment in fuel, materials, or foreign currency. His stocks, meanwhile, would have lost 80% of their real value by year-end, despite appearing stable in dollar terms. But perhaps the most critical strategic shift was psychological. Business owners had to abandon the assumption that currency would recover. Many entrepreneurs kept waiting for the Federal Reserve to fix the problem, for Congress to restore confidence, for some policy intervention to return conditions to normal. This hope was the most expensive mistake possible. Because the mathematics made recovery impossible without accepting economic pain no politician would choose, the debt couldn't be repaid. It could only be inflated away. And that process, once begun, would continue until the currency died completely or until a forced restructuring occurred. The businesses positioned for survival understood this. They weren't waiting for rescue. They were building operations that could function in permanent currency instability. They were treating the crisis not as a temporary disruption, but as the new permanent reality. By autumn 2026, the economic landscape had been fundamentally reordered. Businesses that had dominated their industries for decades were gone. New operations built on crisis-adapted models were emerging. Wealth had been transferred on a scale not seen since the Great Depression. But this time, the transfer was from those holding currency and currency-denominated assets to those holding real goods and productive capacity. The inflation wave that hit in January had become a tsunami by September. Gold approached $9,000 per ounce. Silver crossed $180. The S&P, in nominal terms, exceeded $8,500. Yet the companies it represented were generating fewer real goods and services than they had in 2024. The question was no longer whether the dollar would survive. The question was what would replace it, and whether American businesses could navigate the transition without complete collapse. Those who had repositioned strategically had a chance. Those still operating on the assumption of currency stability were already ghosts. They simply hadn't stopped moving yet.